name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. As I mentioned last week in my commentary, the previous 2 weeks saw prices not only caught in intraday indecisive moves, but intraday indecisive moves. One notable series of price actions going on to the third countering level, a sure sign of intraday indecision. Indeed, this went back as far as mid-April, the end of the run-up from the March to April V-bottom, when the market reached the 21st century 50% absolute Fibonacci level at 1809 and got stuck trying higher and stuck trying lower due to the then overload of support below. I was not talking about the support congestion from the recent 50% Fibonacci line at 1681 down to the 50% Fibonacci, the big October 2016 to April 2020 move at 1649, nor even to the extension of the congestion a little lower down to 1633. No, I was talking about all the things inside that congestion. The rising short medium moving average currently at 1695. The rising medium moving average currently 1664, which both made a golden cross 3 weeks ago, plus the lower time currently 1707 of the December 2020 to April 2021 bullish Andrews pitchfork. All were supporting the market with a single 21st century 50% absolute Fibonacci level overhead being the resistance until last week. As I also said last week, and I quote, "Now don't get me wrong, on the surface we have what looks like strong support that can withstand some testing. However, that barging between levels since late April has either left us with a possible bullish halfway hesitation measured move higher since the V-bottom, or else since April we have a possible triple top type action. Neither solutions are clean or clear. Indeed, I feel as if I am repeating myself from a month ago. However, until we have a clear indication, the range on the wide is going to be the same. It's going to be between the supports 1630 to 1681 up to the 50% 21st century absolute Fibonacci level at 1809. End of quote. Now please remember I said 1630 to 1681 up to the 1809 resistance. So you've got the support 1630, 81, then 1809 resistance. Well, last week the market sived down through the support, gapping lower between the Wednesday and the Thursday, and on Friday reaching down and touching the 1630 support, closing just over it and below all the other supports. Then there's today's action, which in a clear case of not counting your chickens before they've hatched, as I've pointed out many times before, one shouldn't, shows you that despite the aggressive bearishness seen last week, including the breaking of the bullish Andrews pitchfork, which will be retired today, we have seen what looks right now like a combined key reversal up and bullish engulfing pattern today. Now, I'm not even going to count these bullish moves too early either. I will treat them just the same as the bearish ones earlier, once we have confirmation of move back off the recent lows. Then and only then can we say the market is still within, as I put it last week, and I quote, going to be between the supports 1630, 1681 up to the 50% 21st century absolute Fibonacci level at 1809. End of quote. That is all until it changes, of course, again. You see, the excessive indecision is going to make a break one day. ICE Europe white sugar contract. Once more, compared to the New York contract, this one in London continues to be different. The original battered April to July 2020 bullish shift pitchfork is no longer valid and will be retired after this commentary. We now have a new February to May bearish Andrews pitchfork, one I drew last week, giving what looks to be the current bearish angle of attack between the upper time, currently 457.90, and the middle time, currently 412.80. The move down started 2 Mondays ago when the market made a combined key reversal down and bearish engulfing pattern, which along with this new bearish Andrews pitchfork stymied the weekly key reversal up from 2 weeks ago and started last week's move lower. Indeed, by last Monday, a lot of the heavy lifting in the move lower had been done, with closes below all the moving averages bar the long moving average, which is currently 428.40, as well as the recent 50% Fibonacci line at 452.30, and the lower time currently 453.90 of the soon to be retired bullish shift pitchfork. With all this, there was only one more key level to overcome before a significant move lower: the neckline, currently 444.90 of what has now turned out to be the April to date head and shoulders top. This was done last Tuesday and prices dropped down through some dead air all of last week until reaching the next support, the gently rising long moving average below. Now, I had pointed out this head and shoulders top last time. I just didn't place a target X on the downside, which is a shame on my part, but there you go. Well, target X is in the 422.60 area, and I'm afraid the market wouldn't wait for me to speak, and it was achieved last Thursday before I could commentate upon the full extent of the move lower. Anyway, the market overshot both target X and the long moving average on the way down, only halting at the interesting 38.2% Fibonacci line at 419.30, exactly where it held back in late March and early April. Today is going to be a passable impression of being held up there again, but with the added capping effect of the long moving average overhead. The question now is, what next? Well, a partial answer to that is that the action over the whole of this year so far, one can look at it as if it's a very, very large double top, with the neckline of this pattern at the previously mentioned 38.2% Fibonacci line. The thing to watch out for now is a confirmed breach of that 38.2% Fibonacci line, because if that happens, then there's a possibility of a move down to the 390 area. If we don't have that confirmed close below the 38.2% Fibonacci line, then there's a distinct chance of the market not going sideways, but instead all the way back up again. So watch out. White premium spread. After a series of indecisive spinning tops from early May until just before the end of that month, it finally took a decisive, if not initially notable, bearish engulfing pattern 4 weeks ago to resume the fall that had been there since late April. 2 weeks ago, the market dropped down and closed below the neckline of the failed 2020 base head and shoulders top, currently at 75 even. Prices have accelerated lower over the last 2 weeks, closing below the relatively recent shallow uptrend, currently at 70 even, and into the congestion from late 2019 between 56.75 and 66.5, dipping below and out of the congestion but still closing within it. The market now has a new, though lowering support, and that's the middle time, currently at 54 even, with a big bearish May 2020 to February 2021 Andrews pitchfork, which seems to be showing the bearish angle of attack of this market, at least for now. Please note, this is a declining support, as is appropriate for a bearish pitchfork, so please do not think of it as any form of counter to the bearish incentive. It's not. That is currently evident here. It is, as I pointed out last week, and I quote, "Until we see the market move out of these strictures, then this bearish pitchfork will prevail." End of quote. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.